Hello guys, this is Right On Academia, and today we'll be looking at the sum of the years digit method of calculating depreciation. Now this method has to do with our number of years. We'll be summing up the number of years involved as well as calculating the depreciation percentage where necessary. Okay, now there's a question on the screen that a machine was bought for 7,000 naira and it is expected to last for 4 years with a scrap value of 1,000 naira. Okay, so we are asked to calculate the depreciation as well as prepare the necessary accounts. Now using some of the year digit method, I'll be showing you how to solve this question. Okay, so now in some of the year digit method, the first thing is our cost of assets is equal to 7,000 naira. Okay, our scrap value is equal to 1,000 naira, and our estimated useful life is equal to 4 years. Now in case you are just joining us, we've dropped a video on depreciation, the theory aspect. We've also dropped a video on how to calculate depreciation using your straight line method. So this is our second way of calculating depreciation. Okay, now this is our question on the board. We have our cost of assets, our scrap value, our estimated useful life. Now using some of the digit method, let's show our workings quickly. Okay, we have our years, which is 4 years, right? So we'll be arranging for 1, 2, 3, 4. Now since it's some of the years digits, like I said, meaning we'll be adding up these digits. Okay, now for some of the years digits, the bigger number will be coming up first. We'll change this, we'll reverse it, so it will be 4, 3, 2 and 1, because in some of the years digits we believe that the asset was enjoyed more in the first year of its use in the company. So we'll be giving a bigger portion to the first year and then subsequently we'll be reducing it. Okay, so now for some of the years we'll be adding this up. 4 plus 3 plus 2 plus 1, which will give us 10. Alright, now our workings will be multiplying. Okay, or before that, now we'll have to subtract our scrap value from our cost of assets, so that we can have our depreciable income. Okay, so we'll have to subtract. We can just do that by the side. Subtracting 1,000 from 7,000, we have 6,000 naira. So this is our depreciable income. Okay, our cost of assets less scrap value. So we'll be working with this depreciable income right now. We'll be multiplying 4 over 10, okay, which is the sum. We multiply 4 over 10 by this. For this next year, 3 over 10 by this. Okay, so our workings will be 4 over 10 for the first year. 4 over 10 times our depreciable income, which is 6,000 naira. For the next year, it will be 3 over 10, which is the sum, times our depreciable income. Okay, for the third year, it will be 2 over 10 times our depreciable income. And for the last year, it will be 1 over 10 times our depreciable income. Alright, so this will give us what? 2,400 naira. This will give us 1,800 naira. This will give us 1,200 naira. And this will give us 600 naira. So that if you sum all this together, you will have 6,000. Okay, 2,400 naira. Please, sorry about that. It's supposed to be 2 zeros. Alright, so if you sum up this together, you're supposed to have 6,000 naira, which is our depreciable income. Okay, so we've split that over the years. So for every year we'll be adjusting this, but before then we'll be making our depreciation schedule right now. So our depreciation schedule like I said, this is a table that shows our years, our cost of assets, our annual depreciation, our accumulated depreciation, as well as our net book value. Okay, so I will be preparing this quickly. So this is for our years. So our cost of assets, our accumulated, I'm using short form, depreciation. Sorry. This is annual depreciation. Annual depreciation. Then our accumulated depreciation. Okay. And lastly is our net book value. Okay. You can also call this NBV, but maybe in the next video I'll be using that. Alright, so this is our schedule. This is what our schedule looks like. Now let's put in our figures for our first year, our second year, our third and fourth. Okay. Now our cost of assets remains 7,000, right? Since we are using the new method, it means for each year our cost of assets is calculated on the original cost. 7,000 all true. Now our annual depreciation, this is not like the straight line method where we have same values. Since we're using some of the 8 digits, we'll be inputting this value. For our first year, we have 2,400. For our second year, we have 1,800. Our third year is 1,200. And lastly, we have 600 naira. Okay? Now, the next to do is our accumulated depreciation. Like I said, our accumulated depreciation is the depreciation for this current year plus the depreciation for the previous years. Okay, now this is our first year, so there was no previous year, so we only have the current year. So our accumulated depreciation will just be 2,400 naira. Alright, now for our year 2, this is our current year, but we have a previous year, right? So our accumulated depreciation will be this plus this, okay? And that will be giving us 4,200 naira. Alright, for our next year, it will be this current year plus our previous years. We have 2 previous years, right? So summing up together, we'll be having 5,400 naira. And lastly, our depreciation for this year plus the previous year, that will be giving us 6,000 naira. Alright, so for our net book value, it is our cost of assets minus our accumulated depreciation. Okay, the cost of asset minus our accumulated depreciation. So for the first year, we'll be having 4,600. Okay, that's 7,000 minus 2,400. The next year it will be 7,000 minus 4,200, which will give us 2,600. For our third year, 7,000 minus 5,400. Okay, our naira sign minus 5,400, and that will give us 1,600. And lastly, we are having 7,000 minus 6,000, which will give us 1,000 naira, which is our scrap value. Alright. So quickly, let me adjust this 2,800. Okay. So we are through with our depreciation schedule. The next thing we'll be doing now is to be preparing our accounts. Okay, like I told you, in our depreciation we prepare 4 major accounts, which is our asset account, in this case our machine accounts. We also have our profit and loss accounts, our provision for depreciation accounts, as well as our statement of financial position. So quickly I will be preparing our first account, which is our machine account. Okay, this is our credit side and our debit side. Alright, now the rule still remains that asset account are debited, right? And it is the new method, like I told you, we are assuming that the asset is at a constant cost. The cost does not reduce, okay? It's constant. For the 4 years, let's assume it was bought for cash, okay? It was bought for cash and the cost was 7,000 naira. So this is it for the 4 years, alright? So you are through with our asset account. The next account will be opening is our profit and loss account. But now it has been called the profit or loss account. Okay, profit or loss, because in business you either make profit or loss. Okay, so this is it. In our profit or loss account, we treat depreciation as an expense. So for our first year, which is our year 1, our depreciation, so I'll be using short form, for our first year is 2,400 naira. Okay, for our second year, depreciation is 1,800 naira. Our third year, depreciation is 1,200 naira. And for our fourth year, depreciation, shortened form, okay, depreciation is 600 naira. So for each year, this is the money that the business is charging as expenses for depreciation, okay? So the third account to be opening is our provision for depreciation account. This is the account where the company opens to receive all the money coming in as expenses in our profit and loss account. So this money are gathered or accumulated in that provision for depreciation account, okay? So this is our provision for depreciation account. Our credit side and our debit side. Okay. Okay, like I said, this account is prepared to receive in the depreciation that was treated as expenses in our profit and loss. So here we'll be receiving it in as an income. Okay, so an income are usually credited. So it means we'll be crediting this account for the first year. Depreciation coming out from profit and loss account will be using the heading profit or loss, okay, is 2,400 naira for the first year. Now at the end of the year, you balance your account, balance carry down, which is 2,400 naira, and we are done for the first year. Now the second year from our balance carry down, we'll be bringing it forward for the second year. That will be our balance brought down, will be 2,400 naira. Then that same second year, our profit or loss, which is this from here, this our second year is 1,800 naira. So another income came in this year, okay? So if you total this 0, 2 and 4, that's 4,200 naira. So at the end of the second year, we also want to balance that account, have our balance carry down, which is 4,200. Okay, to give us 4,200, and we have closed the account for the year. Now the third year, we have our balance brought down from our carry down, which is 4,200 naira, and depreciation coming in from profit and loss accounts, which is income, for the third year is 1,200 naira. So we'll be entering that 1,200 naira. Okay, total this we have 5,400. Right, at the end of the year, we balance that account. Balance carried down is 5,400 naira. Okay, we have closed the account for the year. And now for our last year, okay, we have our balance brought down from the previous year. Our balance brought down is 5,400. So 5,400, and we'll be adding profit and loss okay, for that year, which is what, 600 naira. These are profit and loss for the fourth year, 600 naira. So we'll be adding that for this year. This is our income in this account, giving us a total of 6,000 naira. Okay, so at the end of the year, we also balance that account. And we have closed the account for the year. Okay, so these are provision for depreciation account. The last account we'll be preparing is our statement of financial position, also known as our balance sheet. Okay, so we are preparing our last account, which is our statement of financial position account, also known as your balance sheet. Okay, so this is our statement of financial position. This is our credit side, this is our debit side. Now this account is prepared to show us our assets and liabilities for the year, right? Usually in our statement of financial position, our assets are credited while liability and capital is debited. Okay, so since machine is an asset, for our first year, our machine is 7,000 naira. Okay, so but to know our net value for our asset for that year, we'll be reducing depreciation. For that year, which is 2,400 naira. Okay, so when you less depreciation for that year, we are left with 4,600 naira. 4,600 naira. Okay, sorry, let me use this. So this is for the first year. Now for our second year, okay, for our second year, our machine value, like I said, is our new method. So our machine value still remains constant, 7,000 naira. But like I said, we are reducing our accumulated depreciation. Okay, so for our second year, our accumulated depreciation, if you followed us, our accumulated depreciation, or you can also see it from this table, that it is 4,200. Okay, that is our first year depreciation plus our second year depreciation. It was 4,200. So when you less that, our asset value will be giving us 2,800. Okay, so this is it for the second year. Now for our third year, our machine value still remains constant, 7,000 naira. And we are also reducing accumulated depreciation for the third year. We are reducing our depreciation, our accumulated depreciation for the third year. And our accumulated depreciation for the third year is 5,400 naira. Okay, and if you reduce that, we are left with 1,600. That's for the third year. Now for our last year, which is our final year, our machine account still remains constant, 7,000 naira. And we are reducing our accumulated depreciation for the fourth year, which is 6,000 naira. Okay, and when we less that out, we are left with 1,000 naira. This is our scrap value. Okay, so that means this is the amount that the company ought to sell the asset at the end of the financial year. So with this, we've come to the end of calculating depreciation using some of the 8-digit method. The next I'll be doing is a video on calculating depreciation using reducing balance method. Okay, so stay with us.